Welcome to the Explainer. Have you ever wondered how professional investors really manage money? I promise you, it's probably not what you've seen in the movies. So today, we're going to pull back that curtain and demystify their entire process step by step. Let's start with a question everyone faces sooner or later. You've done the hard work, you've scrimped and saved, and now you have this pile of cash. Great. But now what? Figuring out how to make that money actually work for you, that's the real challenge, right? Well, when you boil it all down, you've really only got two choices. You can just keep it, stash it away as a safety net for a rainy day or when your income drops. Or you can pass it on. You can invest it. That means lending it to a company or a government with the expectation of getting even more back down the road. And that choice, it really comes down to a fundamental trade-off. Think about it. Are you prioritizing what you want right now, today? Or are you willing to put some of that off for the chance to have a whole lot more tomorrow? This tension is at the absolute heart of all investing. Okay, so before a single dollar is ever invested, a pro needs a blueprint. They have to understand what you're trying to achieve and what your limits are. And that blueprint, it always starts with the most important person in the entire equation, you. Seriously, you can forget everything you've seen on TV. Real professional investing has almost nothing to do with chasing hot stock tips or making risky bets. The very first job of a portfolio manager is to be kind of like a financial doctor. They've got to understand your goals, your financial health, and your unique situation to build a plan that's tailored just for you. And, the first question they're going to ask is, what's the main goal here? Are you at a point in your life where rule number one is just don't lose the money? That's called capital preservation. Or are you really focused on growing that nest egg as big as you can over the long haul? Well, that's capital appreciation. This is so important. You don't just get to pick a super high return and cross your fingers. No. The amount of risk you're willing and, just as crucially, able to take is what dictates your potential for returns. Just like it says, risk leads return. It doesn't work the other way around. So to build that complete picture of you, a pro is going to look at all these different pieces. What are your goals? How comfortable are you with the ups and downs of the market? How much time do you have? Do you need to be able to get your hands on the cash quickly? Even your tax situation matters. All these pieces of the puzzle come together to form your unique investor profile. Okay, so once we have that investor profile locked in, we can move on to what many people say is the single most important decision you'll make in managing your money: asset allocation. The big idea here is diversification. And look, I know you've heard it a million times, but it really is the bedrock of smart investing. Don't put all of your eggs in one basket. Now, the real magic of diversification isn't just owning a bunch of different things. The key is to own things that don't all go up or down at the same time. Think of it like a seesaw, right? When your stocks are having a bad day, you want something else in your portfolio, maybe your bonds, to be holding steady or even going up. That little trick is what helps smooth out the ride over time. And this chart right here, it shows you exactly what that looks like in practice. This is a pretty standard balanced portfolio. You can see the biggest slice is for stocks or equity. But you've also got big chunks for bonds, some commodities like gold, a little real estate, and even some plain old cash. Every single piece has a job to do, and they all work together to balance risk and reward. Okay, so we've got our investor profile, we've got our asset allocation blueprint, but how do pros actually decide which specific company or which bond to buy? Let's get into the nitty-gritty. A lot of professionals use what's called a top-down approach. It's like a funnel. They start way up high with the big picture, what's going on in the whole economy. Then they zoom in a bit and ask, okay, which industries are going to do well in this climate? And only then, at the very end, do they drill all the way down to find the best run, most promising individual companies in those industries. The whole point of all this analysis is to figure out what something is really worth. That stock price you see flashing on your screen all day, that's just the tip of the iceberg. The real work is digging below the surface to understand a company's health, its management, its future potential. That's its intrinsic value. And this brings us to a really powerful idea. Price is a fact. The market gives you a number every second of the day. But value, that's an opinion. It's an opinion formed after hours and hours of deep analysis and careful judgment. And the whole game for a professional investor is to buy something when the price is way below their opinion of its value. All right, so we've got the plan,
the allocation, and the analysis. It sounds like a perfect system, doesn't it? Well, there's one huge wild card we have to deal with, and that's the human brain.
For a long, long time, economic theory was built on this idea of a perfectly rational investor, a kind of investing robot. But then this newer field called behavioral finance came along and basically said, hey, wait a minute, we're not robots, we're humans, and we're driven by emotions and fears and mental shortcuts that can totally wreck even the best laid financial plans. And these are just a few of the classic mental traps we all fall into. We think that stock we own is worth more just because it's ours. We get stuck in our rut and don't make changes even when we should. We treat a bonus like fun money and our salary like serious money, even though a dollar is a dollar. And the most painful one, we often sell our winners way too early, but cling to our losers for dear life, just hoping they'll come back. So understanding this whole process, knowing yourself, building that blueprint, analyzing for true value, and finally managing your own psychology, that's what separates disciplined investing from pure speculation. That's the real secret of the pros. So the real question now is, what's the next move for your portfolio? Are you ready to start thinking like an investor?